Hello, Matt Block here with EWA. Today we are excited to discuss the concept of asset location and how this can add a lot of value in your investment and wealth management plan. Asset location simply means placing an asset class in an account that makes it maximized and tax efficient. I like to use the analogy of football when we talk about investing. So asset location is as simple as saying, we want our quarterback to stay in our quarterback position. You probably wouldn't take a quarterback and put them on the defensive line. They're not built like that. They don't have a skill set for that. An investment portfolio, we see a lot of haphazard moves typically made in an investment portfolio. So Roth IRA, traditional IRA, 401k, a regular taxable or brokerage account, the composition of those investments we've seen a lot of times are the same. There's no thought or detail. That's like having the quarterback on the defensive line. So to avoid that, first we need to make sure that everything is viewed as one plan. Every account that I just described, the Roth, the traditional, the taxable, that's all your football team. The quarterback, we want to go in the right position. So the Roth IRA, as an example, is where we get all appreciation tax-free. After the age of 59.5, everything comes out tax-free, and there's no sequence of return risk because there's no required minimum distributions. Therefore, the Roth should have the highest returning assets, or the highest assumed returning assets. Also, higher volatility is completely okay. So things like equities, large cap, small cap, mid cap, emerging markets, international, should be in the Roth IRA. If you're going to have fixed income, most likely we want that in a pre-tax account. A pre-tax account means you got the tax deduction when you put the money in. It's now growing tax-free, but at the end, at 72, when you're gonna be forced to take required distributions, there will be a tax associated with every dollar that comes out of a pre-tax account. So because that's a partnership with the government, if we're gonna have some safe money and we don't wanna have to take the money at a loss when those required distributions start, we wanna limit variabilities, and we also wanna make sure that our highest returning asset classes aren't getting shared with the government. So this is where we'd wanna have fixed income or lower volatility equities invested in. And then a taxable account is all based upon tax rate, but typically we want to have growth stocks where you don't have to show any tax liability until you actually sell out of them. So a growth ETF that holds a couple hundred equities would be a very good thing to put in a taxable account. What we want to avoid in a taxable account for clients that are in the highest tax brackets would be corporate bonds that are paying interest that you'd have to report as income. And we'd also want to avoid high turnover funds where the capital gains are forced on you. So we want to focus on, again, exchange traded funds, individual securities, and especially growth equities to even avoid paying taxes on dividends or any interest. We welcome any questions. Asset location, if done properly, can add a tremendous amount of value, even millions of dollars of value if done correctly over a long period of time, and especially while you're distributing your money in retirement and creating as much tax efficiency as possible. Even a 0.5% per year of efficiency due to asset location can be a huge difference of money in your pocket versus the government pocket during your most important years of life.